Alright, topic 3 of the final exam review tutorial and the very last topic of Principles of Finance, financial statements and taxation. From what I think, this is a pretty straightforward topic. The concepts are not very complicated, and it very much relates to what we have learned in accounting, which I'm sure everybody here has experienced a tough time in our school, but a tough time means we learn more. So let me first go over the concept and terms. Financial statements. The 3 core financial statements of a company are its balance sheet, income statement, and cash flow statement. The balance sheet's basic format is assets equals liabilities plus shareholders' equity. The balance sheet depicts a company's financial position at a point in a time. The income statement's basic format is revenue or income, because some income is actually not called revenue. Revenue is more meant towards the income you generate from your core business. And for me, I like to call my income that's not generated from my core business just income, but not call it revenue. So the basic format is income or revenue minus expenses equals the net profit. The income statement shows the company's performance from a financial perspective throughout a period of time, usually a year. Cash flow statement's basic format is cash from or used in operating activities plus cash from or used in investing activities plus cash from financing activities. Notice that this bracket is an accounting bracket, meaning if it's used, it's negative. I think it's pretty intuitive. It shows how the company generates and uses cash in a period of time, usually aligned with the income statement. So for whatever income statement period, the cash flow statement will be to match that income statement period. The cash flow statement is the most relevant financial statement from a finance perspective, because in finance we're always interested in cash flows, which we're going to be looking at the cash flow statement to find information on. Now, tax. Tax is an important expense that should not be neglected. Many people don't see tax as a real operational or controllable expense, I should say, because they think every business will have to pay tax anyway. So it doesn't really matter, what the business does, because they think that the business can't control how much tax it pays. They think that, if the business makes more money, of course, there's more tax to be paid. That is true to some extent, but not completely true. Because keep in mind that tax saving strategies can actually create huge additional value for a company. You will learn these tax saving strategies in your future finance courses. In upper year, you start learning about them, and you probably start learning about them now if professors choose to talk about it, but most of the core of this will be in your C-level classes. And Professor Ealing's slides on tax are already very concise, so she only has like a few. So read her slides, and there's no need for me to keep making it more concise for you because it's already concise. Ratio analysis is a common technique used in both accounting and finance to discern certain areas of financial health of a company. Now, these areas can include liquidity, which measures the company's ability to meet short-term financial obligations to maintain operations. For example, paying its utility bill every month, paying its salaries every month so people don't go on strike, and so forth. It could also include solvency, which measures the company's ability to meet long-term financial obligations, for example, maturing debt, and etc. And profitability, which measures how profitable or how efficient the company is using its resources to make money. Now, these 3 examples are not all the areas that ratio analysis cover. Liquidity, solvency, profitability are only 3 examples. Pro forma financial statements. Pro forma means for the sake of form. Pro forma financial statements are meant to emphasize certain metrics, certain numbers, to the readers. For example, if the manager of a company wants to emphasize its net income excluding unusual items to the readers, the manager can create a pro forma financial statement of this sort to the reader, because, as the name suggests, unusual items are assumed to be not repeating, and when things are not repeating, they're not sustainable, so we should take them out of the equation, our analysis. Most pro forma financial statements are not in accordance with accounting rules. Not all, but most, but can be good tools in finance as it helps analysis by providing a view at the company from another angle. So for example, if I provided you a financial statement that depicts net income excluding unusual items, it gives you another picture at the company, and maybe this picture will be very vital to your future analysis.